Ladies and gentlemen, traders and investors, a very warm welcome to our channel Polo Vega. On today's video presentation, we shall talk about the new normal established through the last 3 weeks under the influence of the ongoing US-Israel-Iran war, which has led to a direct rise in oil/gas/energy prices under the threat to global energy security. Because of the disruption of sea traffic through the Strait of Hormuz, the prices of some other commodities dependent on the passage of vessels through the strait has also been affected. The world has now accepted the fact that the interest rates will remain elevated for a longer term than everyone has expected before the commencement of the war. This is a direct consequence of the expected elongated period of stagflation following the sudden steep rise in energy prices and the reduction in supply of oil and gas due to the destruction of refineries, production and storage facilities during the last 3 weeks. This week we also the Bank of Canada, the FOMC, Bank of Japan, Bank of England, the SNB and the ECB maintained the interest rates as they were as a direct consequence of the revised expectations. The current geopolitical situation has resulted in a unified acceptance of increased energy prices, elevated inflation and a consequential global economic slowdown. The longevity of these conditions depend on the protracted length of the US-Israel-Iran war, which was expected to finish in no more than a few days. However, the effects will become more clearer in the next few weeks when we start receiving the economic data tabulated under the influence of the war. The stock market has capitulated during the last 3 weeks and there are clear indications of a change in direction of markets, and one needs to be very careful while taking long trades during these conditions. On today's video we shall see the Dixie, the US oil spot, gold, the S&P 500, the Nasdaq and the Indian index Nifty. Before we move on to our video, let's look at the disclaimer/disclosure clause. The contents of the presentation are for information purposes only. The material is being obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 34th of a series of interactive videos aimed at educating our viewers, and we would like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and options and opinions in our video are solely based on analysis of the market, and we do not guarantee its accuracy, and we do not advise/recommend guide anyone to take any trade based on the contents of the video, and we do not take any responsibility for partial/total losses arising out of trades on the contents of this video. What we see in front of us is that of XAU/USD, which is the ETF based on gold, and this is the daily chart. We've been visiting this chart almost every week, but there is a very important development this week and it can't be ignored. As spoken last week, we were looking at a nice explosive move towards the downside to kind of establish the beginning of a downtrend. As we've seen that there are two highs, one above the other, established in the last 5 weeks after the asset class fell to its new low established at 4400 in the month of February this year. After that it managed to go back up, but it couldn't take out its old high, which was established between 5400 or 5363 and 5600. The new high, which is lower than the old high, was established between 5226 and 5420. After that it went into a consolidation phase during the last trading week, or the trading week before the last one. During the last trading week it printed two dojis around the 5025 area, and then there were nice explosive drops, consecutive ones, right from Wednesday up until Friday. All we need now is that the asset class needs to print another explosive drop and close below the previous close at 4671 or 4650, and its low or the wick end that was printed in February at 4400 needs to be violated, and the new close must be below the blue dark line that we see. Once that is done, then we know that the asset class temporarily is in a downtrend. All we need to do after that is to wait for it to get some rallies into the area above 4750, or say between 5000 and 4900. That's the area where you can try to get into a short trade, or else if it violates this area, then the next show could be line between 5140 and 5250. All said, we have to just wait for another explosive drop to be formed on this asset class, and then we know that it is temporarily in a downtrend. That we see in front of us is that of XAG USD, and it is the ETF based on silver, and we're looking at the daily chart. We have been visiting this chart similar to that of gold for the last few weeks. Although the two metals have had a similar journey, but there is a distinct difference between the two. In case of silver, we see that the high that was attained in the month of January is a nice clean high, and it is very clear of the second lower high that was formed towards the end of February. Also, there was no consolidation in silver as compared to gold in the week before last. In fact, it made another lower high in the week before last, which is between 86.64 and 90.190. After that, it had some nice drops, but they were not explosive ones. And then in the beginning of the week or last week, we can see that similar to gold, silver as well printed two dojis, followed by one drop, and then the second drop was not a drop. In fact, it's a bullish candle, although red in color, but it managed to retrace its losses by a considerable amount to become a bullish candle on Thursday. And then the drop on Friday closed within the candle that was printed on Thursday. So we still need a nice explosive move for silver to establish its downtrend. It is theoretically in a downtrend because we've established two lower highs after the previous high, but it needs to break below the higher low which was printed in the month of February first week. We must get a break below this higher low to establish its downtrend, and once that is done, then we need the metal to rally back into the base area or the area created by the dojis this week, which is in the range of 79 to 82. That's one place where one can go short, or then if this is violated, then we can go for a short between 86.76 to 90.13. And then we have the last area which could pose an obstruction to the upward movement of the metal, which is the area at 96.52. If the metal manages to break above this area, then we are out of a downtrend and we could be going either sideways, or if it manages to break above 121.73, then we resume the old uptrend. So as of now, as we speak, we're waiting for a nice explosive drop for the confirmation of downtrend in silver. The chart that we see in front of us is that of Dixie, the US dollar index, and is the daily chart. Once again, we've been visiting this chart as well for the last 5 to 7 weeks, and as predicted during our last commentary from last week, it has not been able to break out of its range as yet. There is a nice supply area, which is the controlling area between 101.077 to 101.887, right above its range that it has been maintaining between 95.45 and 100.4, the range that has been maintained since April 2025 up until last week. It managed to print a nice green candle on Friday of week before last. Then it printed a similar drop, which was an engulfing candle, and then a basing candle, again a red candle. But on Wednesday, on the basis of the FOMC decision about not following with the rate cut as predicted, it managed to print a nice rally, but that was again followed by an engulfing red candle, because of the reason that the rest of the central banks as well decided not to touch their interest rates or left the interest rates untouched because of the new normal, which is expecting the rates to be maintained for a longer time. The chart that we see in front of us is that of S&P 500 of the ES, and it is the daily chart. Why we're visiting this chart this particular week is purely because the reason that it is at a junction where it could break below a nice bullish area and could result in the reversal of trend. As of now, it had been going sideways for a good amount of time. The range was between 6.784 and 7027. That was broken in the last 2 weeks, and in the last week it managed to print a nice drop, base drop, and the close of the candle on Friday is below the supporting candle between 6617 and 6752. So it has printed a nice drop below this area, and currently it is trying to take out the buying orders between 6600 and 6400, which is the next controlling candle. It's a rally based rally, which is not a very neat formation, as we can see. Maybe we can see this formation on a lower time frame, but if it manages to take out the buy orders from this area, then we will see a reversal of trend getting established, and temporarily the index shall go into a downtrend. on the 240 minutes chart, we can see that there are quite a few rally formations, and we'll need to take out a lot of buy orders before we go below 6400 and get into a downtrend. But as of now, we shouldn't be taking any long trades on this particular index and should restrict ourselves from staying off trades and watching it play out during the next couple of weeks, whether it goes into a sideways trend or whether it breaks below 6400 and we go into a downtrend. The chart that we see in front of us is that of Nasdaq or the NQ, and it is the daily chart. There are similarities between ES and NQ, but the distinct difference between the two is definitively the pattern of formations that we can see. In case of NQ, there were two sideways trends, the first one being between 25,300 to 26,820, and then the next down trend could have been formed, but it went into a sideways trend between 24,403 and 25,714. It's only last Friday that this particular index has formed a nice drop-based drop, closing below the supporting candle between 24,403 and 24,803, and as of now the index is in another buyer's area where it has to counter a lot of buy orders, which is between 23,660 and 24,101. It's only after it breaks below this particular buy-in area and takes out all the buy orders, then we can safely say that the index has entered a downtrend. The chart that we see in front of us is that of Nifty, which is the 50 stocks index on the Indian NSE, and we're looking at the weekly chart. Why we're looking at the weekly chart? Because we would like to establish a broader trend in this particular index, which is supposed to be replicating the Nasdaq or the NQ from the United States of America. But compared to the Nasdaq, the Nifty had been in a bull run up until September 2024, after which it saw a downtrend establish for about 4 months, and then it again reversed all its losses to reach back its old high at around 26,400. But this particular move was very short-lived, and in the past 3 months, ever since the beginning of this year, Nifty has seen some very explosive weekly red candles as compared to the green ones that it used to have about 2 years ago. As we can see that on the weekly chart, it has established a lower high and has seen some explosive drops in the last 3 weeks, and the last week it saw a gap down of about 500 points. It opened 500 points below its former close on the Friday of week before last. Therefore, one now needs to see its behavior there is a doji on Friday of last week that was formed, but if we need to see that it does not drop below its supporting area at around 22231, then it needs to slow down its drop and try to go sideways or with smaller dojis in a consolidation phase before it sees any buying interest. As of now, one can see that the last 3 trading days have been quite bad for the Nifty, and the one on Friday could have been a green candle, but it reversed all its gains and ended printing a red bearish candle. One still needs to wait and see the way the news travels in this part of the world and the way the war shapes the trajectory of the indexes in this part of the world. But as of now, as we speak, the Nifty is certainly in a downtrend with clean areas of shorting established at about 24,450. Then we've got one at 25,790 or 25,800. But we should not try to go short at 23,800, which is where it gapped down from on Wednesday. But it may try to fill this gap up as it has done on earlier occasions as well. If we see that it has had a drop and then it has filled up the gap and then again it has dropped. Therefore, there could be a chance that on Monday or on Tuesday it may try to fill this gap up before coming down further. As of now, all trades on Nifty have got to be shorts and no long trades. But the earliest short that one can enter would be at 24,450, which will give us a nice drop to 23,140 and a good profit margin. Ladies and gents, we hope that our presentation has been informative and exciting enough for you to come back and watch all our videos. On today's video, we've spoken about going by the basics in a volatile atmosphere as of now. And no matter what happens, no matter what direction does an asset class try to move, but if we go by our basics and we stick to our strategies and we stick to the rules, at least we can cut short all our losses and may save as much of capital as possible. We shall continue with our commentary and be touching upon events which are now highlights of the week, and shall also talk about the interesting asset classes each week. But most important of all, we must try to conserve capital and not lose all our capital because of volatile moves or whiplashing moves of any asset class. We would rather stand on the sideline and watch the moves subside to regular moves rather than go in to take quick profits and end up losing all our capital. If you liked our video, please give us a thumbs up and press the bell underneath to subscribe to our channel Polo Vega and watch all our videos. You may also visit us on our website www.polovega.com or get in touch with us through our Twitter handle @PoloVega. Please keep saving, keep investing, and keep getting wealthier until we meet next. We thank you for watching our video, and please like, share and subscribe to our channel Polo Vega.